Well, it was another interesting day on Wall Street. Not only did we have the quasi-IPO for Spotify go off without a hitch today, but we also had kind of a tweet storm from the president regarding his thoughts around Amazon and how they utilize the U.S. Postal Service for their delivery. So a lot to digest there as Amazon shares were going up and down and up and down. But the good news is we did close at the highs of the day, at least on the Dow Jones Industrial Average. The best performing sector today was energy. One of our better performing sectors in recent weeks has been utilities. So in today's trade application example, I want to kind of combine those two thought processes into one trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's April 3rd, 2018. Now, for those of you that are new, first of all, welcome aboard. We're grateful to have you here in our audience today. If you are not subscribed to our YouTube channel yet, we would encourage you to do so by clicking that red button. If you get value out of today's video, make sure you're clicking the thumbs up button to let David and I know that you want us to continue to do these free videos on a daily basis. In addition to that, you're welcome to leave comments for us down below on the YouTube video itself. And then lastly, in our description area, you'll see that there's a few different links. One of those links will allow you to see the sign up for our email distribution list, which will then entitle you to some of the stocks that are giving you overbought and oversold clusters on a daily basis. Now, in addition to YouTube, we're also heavy users of Twitter. We'd encourage you to follow us there and also like and retweet our Market Outlook videos there on Twitter. David and I are building a small business, and so we can use a grassroots effort, and a lot of that comes from you guys, kind of letting others know that are in your social networks about some of the things you're learning about here at Market Scholars. And so anyway, you can follow me at Brandon Van Zee. The Market Scholars handle is at Market_Scholars. We're almost to 1,000 followers on Market Scholars. As a matter of fact, I think the last I looked, we were less than 20 away from that. So if you're not following our company handle yet, make sure you're doing so. In addition to Twitter, we're also on Facebook. And so you're welcome to look at that web address that you see on the screen in front of you and join our group over on Facebook. All right, with that, let's go ahead and do some analysis on the markets here. And you can see I've got the S&P 500 pulled up in front of us. And no surprise, we're still with a bearish posture as it stands right now, and that's why the background color of this particular chart is red. But as I alluded to in the intro, we at least had something to cheer about or celebrate today, as opposed to kind of the carnage that took place yesterday. You'll notice that the S&P 500 did close up 1.26% when it was all said and done here today. So that may be viewed as a positive angle towards this market right now. But as we start looking at this chart and we start staring at that green intermediate line down below, that is the one that we use to establish our posture using the market forecast indicator. And that green line has been traveling from these upper levels right here at about 68 or so and slowly started drifting over and over and over and picking up steam as the stock market itself has continued to fall. And now we find ourselves in that lower reversal zone there on the S&P 500. So important for a couple of reasons. First of all, it does tell us that the posture, the intermediate term posture, is currently strongly bearish. But in addition to that, sometimes you can go overboard with your bearishness or bullishness on Wall Street. No surprise there. The pendulum sometimes swings a little bit too far in one direction or another. And so at some point, if things start unwinding out of control here in coming days, it is possible now with that green line, which is the less sensitive of the least sensitive of the three lines that we follow there. Now with that in the lower reversal zone, it wouldn't be entirely surprising to see the blue and the red lines, which are more sensitive, also join it in that lower reversal zone if we get continued price damage. Now, if that happens, that would entail what's called a bullish cluster. In other words, an oversold cluster. And the thought process is it's so bad it's bound to be good, meaning that things have gotten out of control in one direction and now a reversion to the mean is a little bit more likely. So we're not there yet, but merely pointing out the fact that, yeah, we're back in that lower reversal zone for the first time since going back here to February. And you can see it was a very brief stay in that lower reversal zone for the green line back here in February. So only time will tell how much longer we're in there this time around. But I would suspect we'll be in there a little bit longer on this occasion, partly because the green line did not go up into the upper reversal zone this last time, whereas prior to the time in February, we were in the upper reversal zone there. So we didn't have as much to give back, and therefore my guess is that we're probably going to stay in that lower reversal zone a little bit longer this time around. Notice that the price is below a falling moving average, which is why that line right there is red, that 30-day moving average on this particular chart. All right, let's go ahead and take a look at our next chart setup. And so we'll take a look at our foregrid here. And this will look at all 4 major U.S. indices on one screen here in front of us. And again, if you see the pink backgrounds like we have right now, what it signifies is that we do have bearish postures using that market forecast indicator. You can see that in all cases except for right down here with the Russell 2000, the green line is in the lower reversal zone. The Russell 2000 is a lone holdout, but within a couple days, if we have more price deterioration, we could very well end up in the lower reversal zone for it as well. But in all 4 of the cases, we've got bearish intermediate term postures. We also have red tips of the moving average where price is below falling moving averages right now. So across the board, no matter how you slice it, we still consider the posture bearish, at least here in the United States. As we take a look at our next chart setup, this will be our 3 green arrows chart setup, and here the color scheme changes a little bit where if you see the pink background charts like you do right now, that means that we've got 3 red arrows, and just to catch everybody up to speed on that, that's just a way of looking at 3 different technical indicators to see if they're giving us bearish signals or bullish signals. And so if we want to count them out using the S&P 500 as an example, excuse me, fighting a little bit of a cold here recently, we've got a red arrow up here on the moving average itself as price fell below that falling moving average. We also have a red arrow on the MACD and on the stochastic, so that's why we have those 3 red arrows right there. So generally speaking, if you're a trend-oriented investor, that is not a positive development. You generally want to see a little bit more stabilization of the charts before you go in and take some more aggressive trades to the upside. Moving on now to our next, our next chart setup. This is going to be our longer term chart setup, and again, it's the same 4 indicators here. And on these particular indicators, first of all, the charts themselves are 3 years in length. All the other charts we've looked at up till this point have been 3 months. So these are 3 years longer term charts here. Each one of these candles represents 1 week in time. So reminder that it's only Tuesday. So when we look at the most recent candle on a Tuesday, keep in mind that things can change by Friday, and that candle will continue to change shape throughout the week. But as it stands right now, some important developments, which is in nearly all the cases, you can see we do have price touching that black line on my charts on all of these. I got to double check on the NASDAQ there. Let me right click on NASDAQ and go into maximize sell. Yeah, even on NASDAQ earlier this week, we did touch that black line. We bounced off of it, so the body of that candle is now up here. But at one point earlier this week, don't know if it was earlier today or yesterday, we did touch that black line. Now, we did touch that black line over here as well on February 5th, or the week of February 5th, and that ultimately led to a nice rally, a bounce off of what would be perceived to be a longer term moving average. Remember that black line that we're looking at right there is your 40 period exponential moving average, but we're looking at it on a weekly candle chart here. So if you guys have ever heard the idea of looking for the 200-day moving average and utilizing that as support for longer term investors, that's basically the same concept right there. Whether it's a 40-week or a 200-day, it's right around the same levels. And so all 4 of our charts right now have shown that ability to at least touch that 200-day moving average. Now, the good news is it appears to me that all of them are above that moving average. The only one that I'm not certain about is the S&P 500, so let me maximize that sell, and let's just take a look. Yeah, so we were clearly well below that 40-week moving average or 200-day moving average, however you want to say that. But you can see that where we closed right now is above that moving average. So in all 4 of the cases, I think that's maybe one little silver lining, is that maybe long-term investors really are stepping in to support the market at the 200-day moving average / 40 period weekly moving average there. You can see that what we traditionally are looking for on these chart setups is the crossovers of the moving averages themselves. So you can see that all 4 of those charts have falling orange lines here, which is your 10 period moving average, 10-week moving average in this case. If it were relatable to a daily candle chart, that would be your 50-day moving average. In all four cases, those more sensitive lines are reversing lower and heading towards those black lines. Now, what we generally are looking for are the crossovers of the moving averages themselves. And while prices are touching those that black line right now, we don't have the orange lines crossing the black lines quite yet. So maybe that will happen here within the next few weeks or months. But then again, maybe we'll get a nice bounce out of the markets like we did over here when we were falling back here as well. And a lot of people thought maybe we're going to be crossing, and we didn't end up doing that. So only time will tell. We'll, of course, keep you posted here in these market outlook videos. All right, so let's now go ahead and do some sector analysis. And as a reminder, I do have to kill the camera feed at this point just to make sure that you guys can see every square inch of my my chart setup here, so that way you can see all 12 of these charts. But as a reminder, we do have the S&P 500 in the upper left, and then followed by all the 11 sectors that make up the S&P 500 in the other areas. Now, what's probably catching your eye is that we have 3 green areas down below, and we're back to the market forecast indicator way of looking at that particular chart setup, meaning that in the case of consumer staples, utilities, and real estate, we do have bullish intermediate term postures. In the case of all the other charts out there, we do have bearish intermediate term postures. So it should automatically be excuse me, clicking in the back of your mind that the 3 charts that are lit up in green are generally considered more defensive areas, partly because of the lines of business that are conducted within those sectors, but then also the sensitivity of interest rates. And when the economy starts struggling, or at least it's perceived to be struggling by the stock market itself, interest rates usually start going down. And in response to that, some of those more interest rate sensitive areas like the utilities and the real estate area can generally do a little bit better on a relative basis. So while it's good to see some green on our charts right here, if you're wildly bullish on the markets, those are not the charts that you would prefer to see being green. You'd much rather have technology, industrial, some of those more cyclical areas of the market leading the market higher. But you know, we can't force anything upon the market. We can only react to it. And so it's worth noting that right now, if you're going to be hunkering down in any areas, maybe those are a couple of the areas that make sense, even if they aren't the most exciting sectors to the upside. So again, I'll reiterate that utilities is one of those green areas. And then the other point that I was making on the intro was that energy was our best performer today. Notice that energy was up 2% here today. XLB, which is materials, up 1.4, industrials 1.4, tech was only up 1%, discretionary was up 1.2%, telecom was only up 0.6, financials 1.4%. Looks like we got healthcare at 1.5%, we got staples 1.3%, we got utilities at only 0.3%, and then XLRE at only 0.36%. So point being that while the utilities are an area that have been stabilizing for the last month or so, in today's market environment, we did find that the energy stocks themselves were the best performers. And so, like I said, we'll be kind of combining those two thought processes in our trade application example here in just a little bit. Before we do that, let's go ahead and take a look at our next 12 grid, which would be the foreign markets 12 grid here. And here you can see there's only 2 green charts on our screen. So we've got India and we've got Japan as our 2 foreign country ETFs that are bullish. Now, as a reminder, and I think I mentioned this to some of you a little bit earlier in the week, these are only 12 of the major foreign markets. It's not going to cover other areas, but certainly there are smaller countries out there that have slightly better chart setups. In fact, some of you know that I posted something about that on Twitter over the weekend. In fact, maybe that would give me an opportunity to go over there and kind of explore that together. And again, remind you that if you're not following me at Brandon Van Zee, all one word, and at market_scholars, maybe you should. There's a lot of good stuff that we post out there, including the 9 at 9 that I've been doing on a daily basis again here. If you want to get a good snapshot of what stocks will most likely be moving the market once it opens a half hour after 9 o'clock, make sure you're checking that out every single morning. But in addition to that, I wanted to show you, yeah, here it was. So this is a portfolio of some of the strongest country ETFs out there when using a 3-month performance time period. And so you can see that there are going to be some areas like Egypt, Saudi Arabia, Vietnam, that are doing better. Now, we do cover Brazil in my 12 grid setup, but then there's going to be others like Malaysia and Thailand, Nigeria, Taiwan. We do cover Russia and then Finland. So the point being, with only 12 charts available, at least to make it easy for you guys to view, especially consider some of you listen to this on your cell phones, you kind of have to limit it to some degree. So I do limit it at 12, and I try to make sure that the major markets are covered. But there are some of those smaller countries out there, like your Egypts and Saudi Arabia, that might be worthy of taking a peek at. And you can see those ticker symbols right there if you want to explore those on your own in your own chart. So again, make sure you're following me there at Twitter. All right, let's go ahead and now take a look at our final 12 grid here, which would be the intermarket analysis 12 grid. And here we've got 3 green charts. The rest are pink. Now, the first green chart is volatility. Now, no surprise with the markets being up over 1% today. Volatility itself, the VIX, was down over 10%. So we are establishing ourselves at a much higher level than where we were at the beginning of the year, but that's not an entirely surprising development. Most of you are aware that we were at historically low volatilities for much of 2017. So what we've been experiencing here recently is probably getting us back into more of that norm right there. One thing I will point out here about the Treasury yield, this is your 10-year Treasury yield, ticker symbol TNX. Notice that we had these nice bullish clusters that just got established right here. So this is the yield itself. Remember, that's going to be different than the bonds. Remember, prices are inverse to yields. But what it shows me here is that we have had quite a big pullback in yields in recent weeks. But we now have maybe a slight reason to believe that yields will start rising again. Now, if that's the case, then of course you got to be a little bit cautious around some of your interest rate sensitive areas. Doesn't mean you can't have any exposure to those areas, but it just means you might choose to limit some of your exposure to those interest rate sensitive areas. But right now we've got the long-term government bond that remains with a bullish intermediate term posture for the time being. And again, remember, the assumption would be if this yield picks up to the upside, then eventually this bullish posture on TLT will probably go away. But that's a lot of ifs. We don't know if that's going to happen yet or not. It's just one possible scenario that could unfold. And then we do have the dollar. Kind of interestingly, the dollar is holding up reasonably well here. So maybe money just going into cash right now as opposed to pushing that money into different areas of the stock market. So that's your 12 grid analysis there on the intermarkets. Now, what I wanted to do for our trade application example, let me pull up just a regular 3-month chart using the market forecast indicator. And the stock I wanted to bring up was MDU. This is a small company. This is a utility stock. I grew up in South Dakota myself, but this particular company operates mostly with my neighbor to the north, or my old neighbor to the north, North Dakota. And for those of you that were unaware, North Dakota is one of the country's largest oil-producing states. It wasn't always the case. In fact, when I was growing up back in the Dakotas, oil was not a big driver of the economy whatsoever in either North or South Dakota. So it really hasn't been until the last decade or so where we've realized that potential to tap into the Bakken Shale up there with horizontal drilling and some fracking and some different things going on there. So it's really become one of the better producing areas, not only of the country, but the entire world in that Bakken Shale area. So MDU is a utility company, been around a long time, that operates up in North Dakota. And they actually had significant presence within the energy space for quite some time. They even had their own energy production unit for a while. I think they did end up spinning that off a few years back when oil prices really got blasted. But nonetheless, they have kind of a pedigree of working with the oil and gas industry as well. And you can imagine that in the Dakotas, there's, I always joke there's more cows than people, which I think is probably accurate. There's not a whole lot of population up there. take it from me, not everybody's going to want to live in those conditions where it's 20 below in the winter and blizzard-like conditions in your face, and then in the summer you have to deal with sweltering 100-degree heats with mosquitoes all around you. So I certainly understand why folks don't choose to live in the Dakotas most often. Now, the people there are great, and I'm proud to be from South Dakota, but I can see where outsiders would shun that sort of thing. So, when you're looking at a utility company, you're thinking to yourself, well, what are the various ways you can make money as an owner of the business? And there's a couple different levers you can pull. Obviously, the rates of electricity or natural gas or whatever it is that your utility does with its business, those rates can go up. And remember, they have to work with the Public Utilities Commission, usually called the PUC in most states, in order to kind of work hand in hand with the regulators to make sure that there's an adequate infrastructure to produce electricity and natural gas for the citizens of those states. But at the same time, those regulators need to be able to raise rates for those particular utility companies in order to incentivize them to keep up their infrastructure. So it kind of goes back and forth. Well, that's one way. And another way you can start improving your earnings picture if you're a utility is just simply having population growth. And that's what makes it a little bit more interesting. At least now there is a legitimate reason, other than fresh air, to be living in North Dakota. And that's not a slight, again, to the Dakotans out there. I'm proud Dakotan, so I don't want this to come off the wrong way. But, again, from the outsider's perspective, why would anybody move up to North Dakota, right? Well, now you do have a legitimate reason. You have a robust oil and gas energy industry, and oftentimes comes with six-figure jobs, even for folks that may not have a college degree. And so those are enticing ways to bring in population growth. And so if population growth continues in North Dakota in the future, then of course there's going to be more houses built and more light bulbs turned on and more natural gas used as that population naturally grows. So anyway, utilities, as I've been mentioning here, have stabilized quite nicely in recent weeks and months. And not only that, but this is one of the rare utilities that's actually hitting a new 52-week high. And so if I'm looking at a 3-month chart here, but let me go to a 1-year chart just to kind of highlight that. And you'll notice that earlier this week, we ticked up to 28.29, which was just slightly above this area over here. Some of you might view that as a potential resistance area. Certainly can't blame you for that. But for tonight's trade application example, I guess the point I'm trying to highlight is we're focusing on not only a stock that has a bullish intermediate posture right now, and that's why the background color of the chart is green, but we also have a sector, the utilities. If you look at XLU, it's also green, and we also have bullish conditions there. And not only that, but this particular utility stock is a relative outperformer compared to most of its competitors in the utility industry. Most other utility stocks, well, maybe I could just use XLU as kind of an example here. You'll notice that if we went back and looked at a 1-year chart on XLU, which represents all the utility stocks in the S&P 500, look at, we're way down here, price action-wise, even though the high was way up here. So again, we compare that to MDU, which is a smaller player. It's not part of XLU because MDU is part of the mid-cap 400 index, but nonetheless, in the same space, and it's pushing new highs. So you got a relative outperformer there. So what I thought we would do today is a simple stock-based trade where we're kind of practicing a trend-oriented mentality, and we'll see if we can pick it up reasonably early within that trend. And if not, we don't want to take a whole lot of risk. And so what I thought we would do today is just simply buy 100 shares. That means our capital outlay will only be about $2,800. And what we're going to do is we're going to have a trailing stop on this one that is based off of kind of some of its recent highs and lows. And so you'll notice that I've got these low and high widgets built into my chart. The low price in the last 3 months is $24.29. The high price was $28.29. So just as luck would have it, that's exactly a $4 difference between the high and the low, at least on this 3-month chart here. And so what I thought we would do, just to kind of mix things up a little differently here, is take that as a percentage. So $4 I've got on my calculator here, and divide that by 24.29. And that tells us that the distance between the high and the low over the last 3 months has been about 16%. And one kind of quick and easy way to have some sort of risk management involved in your position, but not go overboard with, kind of maintaining that so much. And that might be appealing to some of you that are interested in utility companies. You're probably not the type that are, focused 24/7 on your computer screen. One of the ways that you can kind of handle that is doing a trailing stop. And so what I think we'll do is we'll have a 20% trailing stop, understanding that the high to low percentage has been 16% in the last 3 months. And so as long as it doesn't go down more high to low going forward, as it did in the last 3 months, we should be good to go with that particular trade. So with that, I'm going to come over here to our paper money account, go to the trade tab. Oh, by the way, I was going to mention as well, Pepsi trade did go off. Some of you recall that when I did a recent video, we sold puts on Pepsi. But unfortunately, the very next day after I completed that video, the stock market was up. And so fortunately, we did have a good till cancel order on it, and it did ultimately get filled here. So just a quick trade update for those of you that might have been following that Pepsi sold put trade. But anyway, back over here to MDU as I type in that ticker symbol there on the platform. What I'm going to do is just simply go to the ask price. Now, I did get a question about this on Twitter over the weekend as well. Don't obsess over the bid ask price on after hours trading. Somebody said, well, I was looking at this ETF that you had mentioned, and there was a $16 difference between the bid and the ask. Should we be concerned about that? Well, if that was real, yes, you should definitely be concerned about a $16 difference between the bid and the ask. But of course, it's not real. Better for the way that you would evaluate that with your mind is look at the platform while the stock market is open. After the market makers go home, they widen out all those spreads in the overnight cycle. Why they do that for certain, I don't know, but I'm sure there's a good reason. So anyway, when we're in the after hours markets, don't obsess over the bid-ask spread. More concerning is what is that difference in the spread when the market's actually open. In most cases, it's only a couple pennies. So in this case, what we're going to do is we are going to right-click on the ask price, and we're going to buy custom with stop. And again, I'm just going to put in a generic 100 shares for this. So I'm just going to leave it at the default for this particular paper money account. And I am going to put it in as a buy limit order of, let's just call it 28.25. I don't know. I'm not going to squabble over a dime here or there. So it closed at 28.12. Hopefully we get filled right around there tomorrow morning. But we get filled 13 cents higher than that, it's not the end of the world in my book. So we'll leave that top line as a day order. The second line here in pink where it says day, I am going to change that one to good till cancel. And then the third line down below here where it says stop, I am going to click the drop down where it says STD for standard. Actually, hang on just a second. That is not what I need to do. I mean, I can do that, it doesn't matter, but oh, you know what I got to do first? Told you I've been sick today, so I've been using too much Chloraseptic spray, apparently. Here's what I need to do. Stop price, we need to change the stop limit. There we go. That will then start allowing some of these other features to, actually it's a trail stop. There we are. So it will then allow some of these other features to appear. And that's what I was looking for. That little widget right there that I'm kind of circling with my mouse. So again, just to reiterate, 100 shares on the buy on the green line on the top as a day order. Second line, it says minus 100 in pink, trail stop, good till cancel. Then that third line there, by default, it might put like a minus 10 cents in there. But in order to do a 20%, which is what I kind of highlighted in the trade, what I need to do is click this little widget here that says plus and minus, click it 2 times until it turns into a percentage, like so. And then in here, I'm just going to type in 20% trail stop. With that, oh, hang on, it didn't accept it, so let me try that again. Let me do this. It doesn't seem to be accepting it, so I'm going to type in 20. So I'm going to get rid of everything that was in there, type in 20.00 and hit enter on my keyboard. There we go. It might have been the difference between that plus and that minus in there. With the trail stops, they might need to see that minus sign in there if you're doing a buy order. So anyway, confirm and send, and we'll look at this one last time here. Again, this is a very small trade, only $2,800, and so we'll send that one off. And again, the idea there then is when we look at this type of a trade, it will go off, And then once it goes off, it will then start trailing it by 20%. It's not doing that right now because the trade hasn't been filled. But once it does, then it'll start trailing it by 20%. And it makes it kind of a hands-off type of a trade. You know, if it continues to motor higher, great. If it doesn't, then we don't have a whole lot of work to do behind the scenes. We just have to let it kind of play out. Okay. So anyway, that's your trade application example for the day. So to round things out for the day, it was an impressive day on Wall Street. It was good to see that after yesterday's bloodbath. Closed near the highs on most indices, closed at the high for the Dow Jones Industrial Average. You know, we've got a lot of different volatile trading opportunities that are out there, and so make sure you're sticking tuned to these market outlook videos for your ideas, your trade ideas, and also your analysis of the markets in general. Not sure at this point whether it'll be me or David with you tomorrow for Wednesday's video, but I know for sure I'll be back with you on Thursday. I look forward to joining forces with you at that time. Best of success with your trades and your investments. Have a great night. Bye-bye.